All right, let's get right into it. We're going to break down how you can shift your entire financial mindset from just being a taxpayer to becoming a financial architect, using the tax code's own rules to your advantage. This right here is the core concept. See, most of us view taxes as this bill that just shows up. But what if you saw it differently? The tax code is actually designed to encourage certain things, like starting a business, investing, and planning ahead. The whole idea is that the system rewards strategy, not just blind compliance. And this slide just lays it out perfectly. You've got two different approaches. The taxpayer is reactive. They make money and then they pay whatever taxes are due on what's left over. But the architect, they're proactive. They build the financial structure first, basically deciding how their income will be treated long before they even earn it. It's a total shift from playing defense to playing offense. So where do you even start building? Well, the foundation of any strong financial plan, your fortress, if you will, is separation. It's about creating a solid legal wall between your personal stuff and your business stuff. This is step one, and it's critical. This is exactly why you hear about LLCs all the time. It's not just some fancy paperwork, it's a legal shield. In the eyes of the law, the business becomes its own person. So if down the road the business gets sued, that shield is what's supposed to protect your personal savings, your car, your house from being up for grabs. But here's how you can wreck that fortress with one simple mistake. If you start treating the business bank account like your own personal piggy bank, that's called commingling funds. You basically give a court a reason to say, hey, there's no real separation here. They can then pierce the corporate veil and poof, that legal shield you thought you had just disappears. So, how do you make that shield real? These are the non-negotiables. First, you get an EIN. Think of it like a social security number, but for your business. You use that to open a totally separate business bank account. From that moment on, every single dollar the business earns goes in, and every single business expense comes out of that account. This discipline is everything. Okay, so the fortress walls are up. Now let's talk about installing the engine, the thing that's gonna make your income way more tax efficient. This is where we move from just protecting your assets to actually optimizing how you get paid. For so many business owners, this is the tax that really hurts as the business grows. That 15.3% for Social Security and Medicare, it gets slapped on every single dollar of profit you make. As you earn more, this just becomes this massive, constant drag on your finances. And here's the fix. It's a game changer. An S Corp election lets you legally split your income in two. Part of it you pay yourself as a reasonable salary, and yeah, you still pay that 15.3% tax on that part. But all the rest of the profit, you can take that as a distribution, which is not subject to that self-employment tax. This one move is huge. I mean, just look at the difference. On 100 grand of profit, the standard way, you're looking at over $14,000 in that one tax. But with the S Corp strategy, it's less than $5,000. That's almost 10 grand in savings just from one structural decision. That's money you can pour back into the business or, your future. All right, next up, let's talk about how financial architects use their assets not just to run the business, but to actively slash their taxable income. This is all about making smart purchases that the tax code actually wants you to make. You can think of this as a fast pass for tax deductions. Usually, when you buy something big for your business, you get to deduct a little bit of its value each year for several years. Bonus depreciation lets you jump the line and take a massive deduction all at once in the very first year. And right now, the rate for this is 100%. Yeah, you heard that right. That means you could potentially write off the entire cost of a major business purchase in the same year you buy it, which can just crush your taxable income for that year. So what kind of stuff qualifies?
The usual suspects: equipment, computers, even certain improvements to property. But the one that gets a lot of attention is the rule for heavy vehicles. So let's say you need a new heavy-duty truck for your business. Not only is it a tool you need, but under this rule, its entire cost could become a giant tax write-off in year one.
So we've built the wealth, we've optimized it. But what about preserving it? The best architects don't just plan for today, they build a structure that can be passed on efficiently to the next generation. This is about legacy. Now, this is one of the most powerful and honestly most misunderstood concepts in the whole tax code. When you inherit an asset, like a house or a stock portfolio, the tax system essentially hits a reset button. Your cost for that asset becomes whatever it was worth on the day the original owner passed away. And this timeline just makes it so clear. Imagine a property was bought for $100,000, and by the time the owner passes, it's worth $500,000. That's a $400,000 gain that would normally be taxed. But if it's inherited, the heir's new cost basis is $500,000. If they turn around and sell it for that price, the taxable gain is zero. Gone. That massive tax bill just vanished. Okay, let's pull all these pieces together. We've talked about a few different strategies, but the real power is in how they create a single, cohesive blueprint. So here's the full architect's blueprint. First, you protect with the LLC Fortress. Then you optimize with the S Corp engine. You accelerate your deductions with tools like bonus depreciation. And finally, you preserve it all for the future using legacy planning like the step-up in basis. It's a complete system built for both growth and protection. And I really want to be clear about this. These are not secret loopholes. They are intentional incentives written right into the tax code to encourage people to invest, grow businesses, and plan responsibly. An architect isn't cheating the system. They're following the map the system itself provides. Now, of course, this stuff can get complex, so working with a tax professional is absolutely essential to make sure you build your own structure the right way. So that leaves us with one final thought. We've laid out the framework, we've shown you the tools. The only real question left is, what are you going to build?